In this weekly series, we've been looking at a full range of different trading concepts that you can use as a backdrop for your own trading. So far, we've talked trend following, fundamental analysis, and trading bands. This week, we're going to turn the spotlight on a concept adopted by some of the richest investors in the world. A trading style which has allowed some to grow fortunes large enough to put them in the top 1%. It's not going to be a trading style which will suit everyone, but in the minds of those students of finance prepared to apply their craft over a lifetime with patience and discipline, there is simply no substitute when it comes to building a fortune. So pay attention as we lift the lid on the concept of trading value. Trading value is a concept that many retail traders ignore in their early careers. It can feel like it has a steep learning curve and is perhaps a little long term, especially when you're eager to rip open a charting package, chuck in a deposit and start hitting buy or sell on the first thing that moves. But when you consider how wildly successful some of the best value traders have been, it's a trading approach worth keeping in mind once you've developed some basic skills and built up a couple of years' experience in the markets. Names like David Abrams, Larry Tisch, Tom Gayner, Michael Burry, Jim Rogers, and of course Warren Buffett are all synonymous with big macro trades that make the headlines. There is a reason why that they're famous, and it's because they've all amassed vast fortunes from understanding one very simple concept: find something that's been undervalued and exploit the opportunity. If we had to sum it up in one sentence, value trading is basically that. You look to buy an asset when it's undervalued and sell it later when it's at fair value or becomes overvalued. As a trading style, it tends to be favoured by the professional end of the market. It's a space occupied by large hedge funds, portfolio managers, and institutional investors. But don't let that put you off. There are no limitations to trading like this and no barriers to entry. And with a bit of work and experience, you too can benefit from using this as a trading concept. All traders who trade value emphasize a trading opportunity where a perceived discrepancy in value is located. However, the question then becomes, how exactly do you define what value is? There is no standardized definition between institutional investors that describes what value is. They all perceive it slightly differently. Probably because in finance, at the end of the day, we can only ever really trade our own beliefs about the market. However, we do have a way of theoretically calculating the value of a company's stock, which can be traced to the work of American professor and economist Benjamin Graham. He pioneered a framework for uncovering undervalued stocks and taught it to his students, including possibly his most devoted disciple, Warren Buffett. His strategy was named the Graham's number technique and was designed as a simple approach to finding the intrinsic value in a stock. That way he could define if the price was under or overvalued. This works by first figuring out what the liquidation value of the company would be. You add up all the company's current assets and estimate the total value if you had to sell it all within the next year. This will give you an idea of how much money it would actually generate. Secondly, you add up all of the company's liabilities and debts, then subtract that from the liquidation value. This is basically what is going on. So for example, if a company's liquidation value was $10 a share and the current share price was $8, then you could effectively buy the stock for 80 cents on the dollar and liquidate it in a worst case scenario for a 20 cents difference. This is what Graham called a value play, and if you consider it's a type of trade backed by real, tangible assets, it's a massive trading edge if you can identify the right opportunity. A value play in its simplest form tends to be very easy to find when the market is depressed. This is why after past market crashes, Warren Buffett has likened stock picking to shooting fish in a barrel. However, this type of trade also requires incredible patience too. We don't tend to see stock market crashes very often, so by implication you need to be prepared and develop a keen eye for tracking the companies you're interested in whilst understanding their true value before a market crash occurs. That way you can act quickly when the time is right. This could be considered a very pure way of trading value, but it's also quite extreme and infrequent. A more common approach is to look for companies with intrinsic assets on their books that have been undervalued given current market conditions. There are various ways of doing this, but a simple illustration would be to look at the value of physical assets on a company's books. This could be something like land or maybe real estate. For example, if a company lists land assets on their books with a value of $2,000 an acre, but you discover the actual underlying market value for the land is $10,000, then you know for certain that you have an undervalued company. The important point is that in theory, this would remain the case no matter what price the stock was currently trading at. Put another way, what purchasing stock in this company would mean is you'd be buying land on the cheap, far below what it was actually worth. So if this type of trading is something that could interest you, then the next question is, how do you get started in understanding how to evaluate companies? There's lots of information online to help you get into the subject, but let's take a quick look at 3 websites which can help you kickstart your career as a trader of value. The first one is Hypercharts, which is now part of public.com. It's a great stock evaluation website where you can see all the key data you'd need to get started when evaluating companies. It's very simple to use, very visual with lots of charts to digest. It's also good for beginners because the focus is mainly on big household names, companies which everyone has heard of. This is very useful if you're just getting started and want to keep things simple. Next up is QuickFS. It's a free website and offers a great overview of different companies with a lot of detail. You can see things like company revenue, profit and loss, earnings per share, and return on assets and equity. It too is very simple to use and great for viewing 10 years worth of data. Lastly is Dataroma. This is a website which helps retail traders track the movements of really large-scale value investors. Whilst it's not a site for copying trades, it can be very valuable to watch the movements and purchases of investors in this space who really know what they're doing. Just by being able to see the companies value trading experts have on their books can be a massive help. You can start digging into the details to understand what it is that they are seeing, take that information and build it into your own analysis framework. Out of the trading concepts that we've looked at so far, it's fair to say that value trading is one of the most simple concepts. However, never mistake simplicity for easy. The search for undervalued stocks requires a serious amount of expertise and experience in analysing assets and waiting for the right moment to act. When you find an undervalued asset, it can be tempting to act immediately. The temptation to buy the very next day can be strong. This is a sure way to get trapped into a losing position. So a good rule of thumb is to never buy a stock that is undervalued whilst it's going down with the overall market. Remember, there is a reason why it's going down. People are selling it. That's a process that could continue for quite some time, and just because it's undervalued today doesn't mean to say that it won't be undervalued in a month from now. Instead, wait and let the price action prove itself to you first. Using oversold indicators and basic technical analysis tools such as support and resistance can be a great guide in understanding the bigger picture and timing the market turn. Being patient and waiting allows you the comfort of then buying with confidence, so you're always trading from a mentally strong position. You could look for candles to form a base over a few weeks and then start looking for a bullish breakout before hitting the buy button. Some would argue that by doing this you'd miss out on some very cheap prices. That is true, but this is where you have to balance the risk of getting in early and suffering a period of drawdown against buying later and sacrificing a cheaper price, missing out on potentially greater profits. However, you can also use this to your advantage. Remember, at the start we said that this style of trading was favoured by many professional fund managers. The size of their purchases means it's difficult for them to wait for a market turn. Once the market becomes bullish, they will find it very hard to get the size they need into the market without pushing the price up against their own buying. If you're trading a small position, then this is never a problem. Therefore, you have a luxury that the portfolio manager doesn't have. Another tip is to always use a simple framework for your analysis. Financial institutions around the world have teams of analysts poring over huge amounts of company data to try and figure out where value opportunities might exist in the market. They will look at huge amounts of fundamental data, earnings reports, forecast projections, future product releases, and consumer sentiment as evidence to try to determine if a stock's price is over or undervalued. This can be overwhelming for someone who is new to trading, but whilst it seems complex, there is actually very little evidence to suggest that this type of analysis is any better than finding value using the simple approach pioneered by Benjamin Graham. So like all forms of trading, keep it simple. The skill of trading value may take some time to learn, and as with all forms of investing, your understanding and application of good risk management will always be the difference between success and failure. There is, however, no question that trading in undervalued assets remains a tried and tested path to long-term wealth creation. Don't forget to check us out on all the socials, subscribe to the channel, and please do leave us a comment below. Next week, we will take a good look at the concept of trading seasonal tendencies.